up ahead. Affirmative 612.
Time for another edition of the Wealthy Pilots podcast, and let's get a little nutty here, a little March Madness. Scott, my friend, we'll talk some correlation between, brackets and the market and investing in a strategy and a portfolio. I guess we're, about a weekend about the time we're taping this, so, for many people, their bracket's probably already busted.
Yeah.
I know mine is. But we'll talk about that. We'll do some fun analogies here about, this annual tradition and, how to not kind of get yourself wrapped up in doing that with your finances, just your basketball bracket. So what's going on, my friend? You doing all right?
Yeah, man. Doing great. Great.
Are you busted?
I don't know. I haven't been tracking the bracket as close as I would like to, but
Gotcha.
Yeah. So
Have to
we'll
go.
see.
We
I
do a
normally
little-
end up on the back to our previous episode. I normally am not good and not lucky when it comes to brackets.
Gotcha. Yeah, me
So
either.
A little bit of both.
We do a little office thing, and I'm usually at the bottom of it. So
Yeah, nice.
But again, in honor of March Madness, so predicting outcomes, right. So that's the topic. If you're like most people, you like to fill it out, you like to have the fun. You feel confident that you're making a pretty good strategy of picks here, and again, you can either get blown apart right off the bat, or you do a little well. And I think sometimes people do that same approach with their retirement, Scott, right? It's like, hey, I got this collection of stuff. I'm pretty smart. I think I got it kind of figured out, and I can kind of predict what's going to happen here. Probably a bad move.
Yeah, it's really interesting. I think the March Madness investing as well speaks a lot to, some of the flaws in our human nature at time and the flaws in our psychology. So, when you think about predicting outcomes and trying to select a certain team, I have not been into college basketball for many years, but I was super into it in high school and early college when I had a little bit more time and less my hand to deal with. But so I used to track all the teams throughout the year and used to know like who some of the key players were and the top handful of teams or whatever. Now, I'd probably still pick like Duke, UNC, Gonzaga.
You go with the classics,
and Xavier as a Cinderella team or something, and some would be like, dude, they didn't even make the bracket this year because it's of that bias of how I used to study and used to build it out based off of how the teams were back then or whatever. So there's a certain bias that comes to our ability to interpret data at the end of the day. And I think predicting outcomes is a really good example of how it's very easy to get lulled into thinking something is going to go a certain way. I'll use, kind of correlating this over to the economy, right? You look at gas prices going up right now with the war in Iran and, some of the geopolitical items impacting some of the market performance and fuel prices, and which is going to impact margins and inflation. And so, you can see how that's going to lead somebody to say, okay, here's what's going to happen. And we're going to get into a recession and et cetera, because they can remember, the war in Iraq or 9/11 or whatever the case is. And think of what happened then. But it's not always the case. The data does not always support that just because certain things happen, that a certain outcome is guaranteed to happen as well. And so, it's very easy to use our bias, and then also very easy for the media or what you see on social media to bias you to think that a certain thing is going to happen. And again, there's recency bias as well, right? Like the things we hear about recently are the things that like drive us to make certain decisions. And that can really, really be a bad habit when it comes to building your investment process. This is where you've heard us say many times, the markets respond to news. News is unpredictable, therefore markets are unpredictable. And so there's a certain level of unpredictability in the market, especially short term, that can drive people to make a lot of bad decisions. And so we don't want to get anchored into what is going on recently to drive us to make bad decisions. The same thing could be in your bracket, right? Hey, I saw one team blow out another team. Well, let me go back and rebuild my bracket and say that this team that just blew out another team is going to win the whole thing. Not necessarily the case.
True. Yeah. And you talked a little bit earlier about upsets, right? And, I think we all love a good Cinderella story, certainly in the sports world. And a lot of times I feel like some people, we gravitate towards, kind of picking that, right? And I think sometimes we want to see that happen with and it doesn't necessarily have to be in the market either, right? It could be anything about your retirement or financial life where you kind of want this Cinderella, you want this feel good thing. Hey, I just found out that this, I could do this tax thing and it's let's talk like Roth conversions, for example. Oh, wait a minute. I can move all of my 401 money. I got $1 million in a 401. I can move it all over to a Roth and it be tax free. Sweet. Let me do that without thinking about, okay, that's a great little Cinderella story, but now you just busted your own tax bracket.
Yeah.
And now you got a tax issue, right? So,
yeah, I mean, and when I think about upsets, I think about, I'll almost say like betting on things when they're down. You know what I mean? We had the longest shot in the Kentucky Derby either this last year or year before. It was the longest shot.
Yeah.
One. Rit Strike, I think was his name. And so there's a little bit of like, those upsets. We all love a good upset story for
Absolutely.
sure.
Yeah.
But to me, this almost, when I think of like, the upsets in the investing world, to me, I think it's like where people are chasing track records and they're looking to say, hey, S&P 500 has been on a tear the last 2 years. I need to reallocate my portfolio to be more heavily tilted or all in on the S&P 500. Mm-hmm. And then pretty much immediately after you do that, we get into a tariff trade war and the S&P is getting hammered and international blitz up 18% in 2 months. And where I think the disciplined person is going to know, hey, I'm not going to give up on my winners, but I am going to take a portion of my portfolio. I'm going to bet on those that are down right now. And so, we believe in, trying to buy things when they're cheap, buy them when they're beat up, buy up those beat up assets, and then wait for their time in the sun to come back. And so again, if you were buying stock in basketball teams and you were going to get a much larger payout for some of those 16 seeds, which you typically do, right, or those lower seeds, if you didn't get a larger payout for those lower seeds, probably wouldn't bet on them. And so,
yeah.
And so that's where I think, there's an element of, when we look at whether it's on the investment side or on the tax side, we want to make sure that we're being intentional and going back to our process versus getting emotionally involved with making a decision based off of our bias,
Right. Well, on that point, so let's talk about that. So when we're thinking about March Madness, often we pick our own teams, right? So if you're a homer, and you're a true homer, you pick, doesn't matter. Like, it doesn't matter if your school has not done very well this year, right? So like my brother is a homer for a specific team here in the Carolinas. They've barely squeaked in, you know what I mean? But he's like, but I'm going to pick him to go the whole way. And it's like, because he's a homer and that's totally fine. But think about your pilots and things like that. Think about people who work for a company. So much of their stuff is tied into their income is tied into this particular company, this particular one item. You got to be careful there too, right? That you're not waging too much of your life on just this one thing. This is back to diversification. It's not just portfolio diversification, diversification or tax diversification. It's also like income sources and streams, right?
Absolutely. And I mean, the airlines have had their ups and downs for sure. We're in an up season right now.
Right.
But those down seasons will come. And I agree with you. If there's furloughs and things of that nature, the last thing you want to do is have your income go down, your 401k contributions go down, and then a huge lot of employee purchase stock also in the same company also go down. Right. And if those things are going down, they tend to go down together.
Yeah, exactly. And you get like Enron vibes, and you don't want that. Yeah.
And so I think, ultimately, I've never talked with a Delta pilot who owns a bunch of Southwest stock, never talked to a Southwest stock pilot that owns a bunch of United stock. I mean, it's, and again, the stock purchase plan is typically what's driving some of that. But if you really go back and run the numbers on most of the stock purchase plans, I mean, it's, the performance of the underlying assets is not typically keeping up with the market, I should say.
Right. And that's why they have other investment streams, though, other sources, other things, right? Maybe they're doing real estate. Maybe they're doing, investing in a small business or whatever.
For sure. Yeah. So the way I look at when I think of like picking your own team to win, the way I look at that, I think of two things. One, I'm not a huge fan of buying the company stock. I know you get it at a discount, but like,
Sure.
If you could give me an employee stock purchase plan where I could just buy the S&P 500 at a 10% discount, I'm all for that all day. But many of the airline stocks aren't keeping up with the market in long seasons of time, and so you hate to buy something at a discount and tie up assets that's just underperforming the broader market. So that's one aspect of it. But the one thing I would say is like, hey, when it comes, we do want you to bet on yourself. Like you're at an airline, you
for sure
your whole life to be there. Like, hey, we want you to bet on yourself that you're going to be able to go make more money and increase your career and upgrade aircraft and then upgrade again and kind of go through that career progression and see your income grow and grow significantly. So when we're building in a plan for that, I don't typically build the plan off of where their salary is at today. We're going to build it off of the anticipated salary growth. So we want that aspect of it in terms of like betting on yourself for sure.
Okay. All right. So at the end of the day, right? I mean, it's fun, talking about March Madness, building your bracket, if you get busted, not a big deal. If you took some risky picks, right? Maybe you went in and said, I'm taking all the underdogs to win the whole thing to make the Final Four. You're not really out anything, right? So just you don't want to do the same thing with your actual finances. And I don't know that anybody probably actually would, but I do think that we tend to sometimes, maybe just through not touching anything or making any changes or even just having a strategy, Scott, sometimes we maybe just taking risks we just didn't realize because we just left it be, or we did the did nothing plan sometimes.
Yeah, it's interesting when it comes to risk in a portfolio. I look at it one of two ways. When we talk about the core portfolio that you are going to live off of in retirement one day, many, many times we're asking people to take more risk with that portfolio. However, I expect them and I want them long-term to get more return with that portfolio through owning the right long-term assets that you can hold forever. And, so there's times where we might need to take more risk, but we expect to get more return. The individual stock picker, the data would tell you they're taking more risk and getting less return on the average. And so that's bad investment policy. We do not want to engage in anything, stock picking, chasing track records, market timing, where we're going to increase risk and the historical data says we're going to get less return.
Yeah.
Now, that's the retirement nest egg. So that's kind of my philosophy there.
Right.
Now, I will say for those that are like, hey, I do want to own some other stocks. I want to take some risk on some stuff. Let's carve out a portion. Again, back to having a plan and a process. Let's take 5% of what you got. Let's put it in a separate account, and then you do whatever you want with that account.
Yeah.
You want to put it all in silver or Bitcoin or Nvidia, whatever the case is. If it goes to zero, it's not going to make a big difference.
Yeah, it's your Vegas money. It's Vegas money. Yeah.
And so, but even with people that kind of have those quote unquote play accounts, Mark, I see it all the time because we end up rolling them into their broader, future retirement dollars. Hey, I started that with the intent to get into some stocks that a buddy of mine had told me about. And then I got into it and then I didn't really follow up with it. I've had them forever. They've done terrible, but I got them, And so we see that frequently where I'm going to take some risk, but there's no exit strategy. All right. I mean, again, if you go talk to some private equity guys, they're going to tell you, we want to go find a beat up business that's got capability for profitability, and we can scale the business, we can increase the profitability, we can upgrade the technology and the management team, et cetera. And their goal is to target 25 to 35% returns for 5 years. And then they're selling that thing for a large multiple. That's the private equity model. And then sell, grow it and sell.
Yep.
Very, very rarely are these, PE portfolio managers wanting to hold something for years and years and years and years and years, because it gets hard to continue to keep that rapid scale of growth. And so, to me, it's that kind of thing. You want to have an exit scenario out of these quote unquote risky investments as well. Like when you hit a certain threshold of success, when are you out,
Yep.
And you can set up alerts for all that stuff. It's very easy to do, but it takes some process. It takes some discipline. And most people just don't have the time and energy for that when it comes to that, part of their lives, I guess I'll say. So,
yeah, at the end of the day, right, you got to have a process and a strategy, even if it's just picking March Madness brackets.
Oh yeah. Yeah. So So we'll see how the brackets hold up. Like I said, when it comes to investing, I feel like we've been lucky to be really good, and maybe good to be lucky at times. When it comes to March Madness, never been good or lucky. So we'll see how it goes this year. But
all right, my friend. Well, I know you've got, between running the business and your own basketball team full of ladies at the house
with subs, by the way.
Exactly.
Yeah.
You don't have as much time, but hopefully you had a little bit of fun this week here on the podcast, folks. So as always, get a strategy, right? Have some fun with things like this, and then be serious with the things you should be serious on. So if you need some help, of course, Scott's always here. Just reach out to him at retireairlines.com. That's retireairlines.com. We got links in the show descriptions below, and hit that subscribe button on Apple, Spotify, and of course right here on YouTube. And if you want to get started with the toolkit, Molly will come on and tell you how. So we'll see you next time, brother. Have a great week.
See you soon.
All right. We'll catch you next time here on the Wealthy Pilots Podcast with Scott Osborn.
Thanks.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own Financial Flight Control Toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.